Imagine waking up tomorrow and turning on your phone and the first headline you see says a major economy has just been cut off. The IMF said no bailout, no lifeline, nothing. Now you might be thinking, okay, that's somebody else's problem, that's happening over there, what does that have to do with me and my money? And that is exactly the question I want to answer today. Because when a country gets cut off from the world's lender of last resort, what follows is not contained. It ripples, it spreads. And in 2026, with more countries under financial pressure than at any point in the last 2 decades, this is not a theoretical conversation anymore. Let's talk about what actually happens to them, to global markets, and to your portfolio. Before we get into what happens when the IMF says no, I need to make sure you actually understand what the IMF is, because I think a lot of people have heard the name but couldn't tell you what it does if their life depended on it. The International Monetary Fund was founded in 1944 at the Bretton Woods Conference, a historic gathering of 44 nations that sat down after World War II and essentially redesigned the global financial system from scratch. The idea was straightforward. The world had just watched the Great Depression devastate economies globally, and a massive part of that devastation was countries unable to stabilize their currencies, unable to pay their debts, spiraling into economic collapse that then destabilized their neighbors. The IMF was created specifically to prevent that from happening again. Today, the IMF has 190 member countries. It holds approximately $1 trillion in financial resources, and its core function, the one that matters most for this conversation, is acting as the world's lender of last resort. When a country is in a financial crisis, when it cannot pay its debts, when its currency is collapsing and foreign investors are fleeing, the IMF is the institution they call. It's like the emergency room of global finance. When nowhere else will take you, the IMF is supposed to be there. But here's what people don't fully appreciate. The IMF doesn't just hand out money with no strings attached. Not even close. IMF loans come with conditions. These are called structural adjustment programs or conditionality requirements. In plain language, it means the IMF tells you exactly what economic policies you have to implement in exchange for the money. Cut government spending, raise interest rates, privatize state-owned enterprises, reduce subsidies, reform your tax system, and you'd better comply because they will audit your progress, and if you don't follow through, they cut you off. Now, those conditions are deeply controversial. Critics, and there are many serious economists among them, argue that IMF austerity conditions often make crises worse, not better. They force governments to cut spending precisely when their populations need support most, triggering social unrest, deepening recessions, and sometimes causing the very collapse they were meant to prevent. Supporters argue that without those conditions, the IMF would be handing blank checks to governments with no incentive to fix the underlying problems. It's a genuine debate with serious evidence on both sides. But here's what's not debatable. When a country gets access to an IMF program, it sends a signal to global financial markets. This country has a credible path forward. The international community is backing you. You can keep doing business here. And when the IMF says no, or when talks break down, the opposite signal goes out, and that signal can be catastrophic. So what actually triggers an IMF refusal, and why in 2026 is this a more urgent question than it's been in years? Let's get into that right now. The IMF doesn't refuse bailouts arbitrarily. When it says no, or when negotiations collapse, it's usually for one of a handful of specific reasons. And when you understand those reasons, you start to see exactly why 2026 is a year where this risk is very, very real. The first reason the IMF refuses is what's called debt unsustainability. The IMF has a rule. It will not lend into a situation where the debt cannot realistically be repaid. If a country's debt load is so extreme that even with austerity and reforms the numbers simply don't work, the IMF will say, we're not going to throw good money after bad. This is what happened with Greece in the early stages of its 2010 crisis. There was genuine internal IMF debate about whether Greek debt was sustainable enough to justify a program. The same dynamic came up with Argentina repeatedly. The second reason is political non-compliance. The IMF extends a program, the country commits to reforms, and then, especially after an election or a change in government, the new leadership walks back the commitments. Venezuela is the textbook example here. The government's repeated refusal to implement the structural adjustments the IMF required meant that formal IMF programs were effectively off the table for years. Zimbabwe faced similar dynamics. And in 2026, we're watching this play out in real time in at least 2 or 3 major emerging economies where populist governments are under intense domestic pressure to reject IMF conditions. The third reason is geopolitical. This one is newer and increasingly important. The IMF is dominated by its largest shareholders. The US holds the largest voting share at approximately 17%, which gives it an effective veto over major decisions. China, the EU, and other large economies also hold significant weight. When a country seeking assistance is geopolitically at odds with major IMF shareholders, the politics can get in the way of the economics. We saw echoes of this during the COVID era, and in 2026, with US-China competition reshaping global financial architecture, the geopolitics of IMF access are more complex than they've been since the Cold War.
Now, let me give you the 2026 context that makes all of this urgent right now. According to the IMF's own data, the number of countries classified as being in debt distress or at high risk of debt distress has hit levels not seen since the heavily indebted poor countries crisis of the 1990s. As of 2026, approximately 60% of low-income countries are in or at high risk of debt distress. But this isn't just a developing world story anymore. Several middle-income countries, some of them with significant connections to global supply chains and financial markets, are in increasingly precarious positions. The combination of aggressive interest rate hikes by the Federal Reserve and other major central banks between 2022 and 2024, the lingering effects of COVID-era borrowing, elevated commodity prices, and a stronger US dollar has created a perfect storm of external debt pressure for vulnerable economies. When the dollar strengthens, countries that borrowed in dollars, which is most of them, find their debt repayments becoming dramatically more expensive in local currency terms. It's like taking out a mortgage that automatically gets bigger every time your employer cuts your pay. And here's the key question you should be asking right now. Which of those vulnerable countries, if they get cut off from IMF support, could trigger a ripple that reaches your portfolio? Let's look at history to understand exactly how that works. History is the best teacher we have here, and the history of countries that either got cut off from IMF support or collapsed before a program could be arranged is not subtle, it is brutal. And the contagion, the way those crises spread to completely unrelated countries and assets, should genuinely alarm anyone with money in global markets. Let's start with the Asian financial crisis of 1997 and 1998. Thailand's currency, the baht, collapsed in July 1997 after a speculative attack. Within weeks, the crisis had spread to Indonesia, South Korea, Malaysia, and the Philippines. These were economies that had nothing structurally wrong with each other in the same way, but they were all in the same region, all perceived as similarly risky by global investors, and when panic set in, capital fled all of them simultaneously. The IMF stepped in with programs for Thailand, Indonesia, and South Korea, but the conditions attached, particularly in Indonesia, were so severe that they contributed to political instability and the fall of President Suharto after 32 years in power. Indonesia's economy contracted by over 13% in 1998. Stock markets across Asia lost between 30 and 80% of their value. And here's the part that matters for you as an investor. The Dow Jones Industrial Average, safely sitting in America, dropped over 10% in a matter of weeks during the worst of that panic. Contagion is no respecter of borders. Argentina, 2001. This one is particularly instructive because it involves an IMF program that broke down. Argentina had been struggling through the late 1990s under a currency peg to the US dollar that made its exports uncompetitive and its economy rigid. The IMF extended support, then pulled back as Argentina failed to meet fiscal targets. In December 2001, the IMF declined to release the next tranche of a scheduled loan. Within days, Argentina defaulted on approximately $100 billion of sovereign debt, at the time the largest sovereign default in history. The peso collapsed. Middle-class Argentines who had savings accounts denominated in pesos that were pegged to the dollar watched their savings lose 2/3 of their value almost overnight. Supermarkets were looted. 5 presidents resigned in 2 weeks. The poverty rate went from 35% to over 50% inside of 2 years. And then there's Greece. Between 2010 and 2018, Greece went through 3 separate IMF European Union bailout programs totaling approximately 280 billion euros. But the period of maximum danger, the summer of 2015, when negotiations between the new Syriza government and creditors, including the IMF, essentially broke down and Greece held a referendum on bailout terms, offers the clearest modern example of what a near miss looks like. Greek banks imposed capital controls. ATM withdrawals were limited to 60 euros per day. Tourism collapsed. Greek GDP had already contracted nearly 25% from its pre-crisis peak. European markets fell sharply in that summer period as genuine fear of a Greek exit from the Eurozone, a Grexit, spread through financial systems. Three very different countries, three very different crises, three very different sets of IMF decisions, and in every case the fallout was far larger, far faster, and far more globally connected than most everyday investors anticipated. The lesson? When the IMF walks away from a country, or a country walks away from the IMF, you need to be paying attention, because what happens next rarely stays contained. Now, let me show you specifically what to watch out for in 2026, and more importantly, what you should actually do with your money to protect yourself. Alright, let's get specific, because I know you're sitting there thinking, okay, which countries are we actually talking about in 2026? Who are the real risks? Let me walk you through the key situations you need to be watching. Pakistan is at the top of almost every analyst's list. As of 2026, Pakistan is deep into its IMF program, one of the largest in the fund's history relative to the country's quota, and compliance has been shaky. The country's foreign exchange reserves have been dangerously thin, its inflation has been running at elevated levels, and the political situation remains volatile following years of instability. If Pakistan's program breaks down, if the government reverses reforms under domestic pressure, the risk of a disorderly default becomes real. And Pakistan is a nuclear-armed nation of 240 million people with significant regional strategic importance. A crisis there does not stay quiet. Egypt is another one. Egypt has had multiple IMF programs in recent years, and its economic situation remains precarious. Tourism and Suez Canal revenues, the two main sources of foreign exchange, have both faced pressure. Egypt's debt servicing costs as a percentage of government revenue are among the highest in the emerging market world. If there's a significant external shock, another commodity price spike, a regional conflict escalation, a sudden reversal of capital flows, Egypt's ability to stay current on its program commitments comes into serious question. Then there's the broader sub-Saharan African debt story. Ghana completed a debt restructuring in 2024 after a severe crisis. Zambia took years to resolve its debt restructuring. Ethiopia and Sri Lanka are both navigating post-default recovery. These are not isolated incidents. They represent a systemic pattern of over-leveraged sovereigns hitting a wall as cheap money-era borrowing comes due in a high-interest rate environment. The IMF is genuinely stretched, and there are serious questions about whether the fund has enough firepower and enough internal consensus to handle multiple simultaneous major crises.
And here's the contagion mechanism you need to understand. When one emerging market goes into crisis, institutional investors, hedge funds, pension funds, emerging market ETFs don't just reassess that one country, they reassess the entire asset class. Emerging market bond funds and equity funds experience outflows as investors reduce risk. That drives up borrowing costs for every other developing economy simultaneously, even the ones with solid fundamentals. It's guilt by geography and asset class association, and it can turn a manageable regional problem into a global one faster than most people think possible. So what does the smart investor do with all of this? Let's talk about exactly that. I want to be straight with you here. You don't need to become a sovereign debt expert. You don't need to track IMF board meetings, but you do need to understand how these macro risks feed through to your actual financial life. And you need a framework for positioning yourself so that a crisis on the other side of the world doesn't blindside your portfolio. Here is your 5-part framework. Write these down if you're serious about this. First, audit your emerging market exposure right now. If you own any broad international equity ETFs or bond funds, go look at their holdings today. Funds tracking international indexes often have meaningful allocations to emerging markets. Some emerging market ETFs specifically hold sovereign bonds from exactly the countries we've been discussing. That's not necessarily wrong. Emerging market exposure can add diversification and return potential, but you need to know what you own. Don't let a crisis in Pakistan or Egypt hit your portfolio before you even realized you had exposure there. Second, understand the difference between emerging market equity and emerging market debt. These behave very differently in a sovereign crisis. Emerging market sovereign bonds, especially those denominated in US dollars, carry direct default risk. If a country can't pay, those bonds can get restructured and you take a haircut.
Emerging market equities are different. Companies within those countries can sometimes perform reasonably even when the sovereign is in trouble, particularly if they're exporters earning hard currency. Know which category your exposure falls into. Third, in a world of elevated sovereign risk, the quality of your fixed income holdings matters more than ever. If you're holding bonds in your portfolio for stability and income, prioritize investment-grade sovereign debt from countries with strong fiscal positions. Think U.S. Treasuries, German bunds, Swiss government bonds, Canadian or Australian sovereign debt. Yes, the yields are lower, but you are buying yourself insurance against contagion events. In a genuine emerging market crisis, high-quality sovereign debt typically rallies as investors flee to safety. That's the flight to quality dynamic that has played out in every major global financial stress event of the last 30 years. Fourth, pay attention to currency dynamics. When emerging market crises hit, the US dollar typically strengthens as capital flows into safe haven assets. A stronger dollar sounds great if you're American, but it actually creates its own pressures. It can hurt US multinational corporate earnings, it makes US exports less competitive, and it further tightens the financial conditions for the very emerging markets under stress, potentially worsening the crisis. If you hold international assets, hedged currency versions of those funds, where the currency risk is neutralized, are worth considering in an environment where dollar strength could be volatile. Fifth, and I cannot stress this enough, maintain dry powder. Having a cash reserve that goes beyond your basic emergency fund means that when a genuine crisis-driven market sell-off hits, you are a buyer, not a forced seller. The people who come out of financial crises ahead are almost never the people who had the most perfect portfolio going in. They're the people who had the liquidity and the conviction to buy quality assets when everyone else was panic selling. In 2026, with elevated sovereign risk globally, maintaining the ability to act opportunistically during volatility is a genuine competitive advantage. Now, I want to be honest with you about something. None of these moves guarantee that you come through a major global financial crisis unscathed. They don't. In a genuinely severe scenario, a simultaneous multi-country default event, a complete breakdown of IMF credibility, all asset classes get hit. The goal is not to find the magic investment that goes up when everything else goes down. The goal is to reduce how much damage you absorb, maintain your ability to recover, and, if possible, be positioned to capitalize on the opportunities that crises always create for prepared investors. The people who built generational wealth during the 2008-2009 financial crisis were not lucky. They were informed, they were liquid, and they had a plan. You have the opportunity to be those people in whatever comes next. Let's bring this home. Here's where we land. The IMF is not just a technical financial institution that nerds in Washington argue about. It is a critical piece of the architecture that holds the global financial system together. When it works, most people never notice it. When it fails, or when a country falls outside its reach, the consequences are fast, severe, and contagious in ways that reach into stock portfolios and savings accounts far from the original crisis. In 2026, more countries are under financial stress than we've seen in a generation. The combination of COVID-era borrowing, aggressive monetary tightening, geopolitical fracturing, and a stronger dollar has created a landscape where the question is not if a major sovereign debt crisis will test the global system, but when, and how the IMF and its member governments respond to that test. You now know how the IMF works, why it sometimes says no, what happens historically when the safety net disappears, which situations are most worth watching right now, and what 5 concrete steps you can take to protect your financial position in this environment. That is a lot more than most people know. Use it. I want to hear from you in the comments. What country do you think is the biggest IMF risk in 2026? Do you currently have emerging market exposure in your portfolio, and are you comfortable with it after watching this? Drop your answer below. I read every comment, and some of the best conversations on this channel happen down there. If this video gave you something useful, something that actually changes how you think about your money or global markets, hit that like button. It genuinely helps this content reach more people who need to understand these risks. And if you haven't subscribed yet, I'll be blunt with you. You are missing the briefings that serious investors use to stay ahead. Subscribe, turn on notifications. Tell one person in your life who has money invested that they need to watch this. Coming up very soon, we are breaking down what happens when a currency war breaks out between major economies and why it might already be starting in 2026. That one is going to change how you think about international investing. I'll see you there.
And take care of your money. I'll be back soon.